On Talking Point today, we're speaking with Chetan Seth, APAC equity strategist at Nomura. Chetan, great to have you on India Market Open, and at a time when we can start talking about what's next and what the outlook for 2026 also looks like. Let's begin with, I think, one positive surprise as we've entered the calendar year is in terms of corporate earnings and the improvement we've seen there. You believe that we will build on this, isn't it?
Yes. I mean, just speaking regionally, we have a constructive view on stocks, at least into the early part of 26. And the main reason there is that we think earnings growth rate in 26 will be quite strong. In fact, 4 large markets in Asia, which also includes India, will see double-digit earnings growth rate. So that's China, Korea, Taiwan, and also India. So we do have a positive stance on stocks. Maybe second half, there may be more challenges for stocks, but generally we are quite constructive.
Down a bit on India, where you're also seeing amongst this larger bucket, double-digit growth in terms of earnings. Are valuations now matching up?
So India valuations stay quite elevated. We look at MSCI India trading around 22 times. So actually valuations in an absolute sense have not come off, but there is one comfort that we have as far as India is concerned when we look at India from a regional angle, is that relative valuations, so India against the entire region, look far more attractive to us. And just to give you a number, India is trading at a premium of around, let's say, around 57-58% to AEJ, Asia ex-Japan. Historically, this premium is pretty much around, call it 50% level. Back in September 24, this is when India started underperforming. This premium was almost 100%. So the valuation gap has come off because many other markets have rallied quite hard. So one of the reasons we are staying constructive on India is that we think India equities will prove to be a big diversifier for regional portfolios given its underperformance. And then we'll also have a support of earnings. We also think policy has clearly become very supportive. And then looking forward, we are expecting some cyclical recovery, both on the economy side as well as on the corporate earnings side.
Chetan, morning, Alex here. As much as I would love to be terribly bullish heading into 2026, and you would want for Indian companies to do well, a few things give me cause for concern, which is that nominal GDP has slid quite sharply, and that is tied to corporate earnings. And the argument for a significant top-line growth for India's top companies is difficult to make in that context. Would you agree? And do you see it changing in 2026, given the policy initiatives that have taken place?
So, when we look at MSCI India, the consensus is looking at around 16 to 17% earnings growth rate. In fact, our view from our India team is that I think India, you will most likely see these earnings estimate also, to be brought down through the year. So we are penciling around 3% earnings risk. But let's say if you get 14%, we think it's still quite healthy. Even if you don't see any multiple expansion, and we're not penciling any multiple expansion, through the year, you could still make 10 to 12% returns on India equities. So in fact, our India team is looking for Nifty to end around 29,300 levels by end of 26. So I think expectation, as you know, Alex, always starts quite on a high note, but through the year there is always disappointment. I think in this time around it will not be dissimilar. In fact, this is quite possible. This will be the trend most likely in rest of Asia as well. But even if we get double-digit earnings growth, I think markets might be okay. I think the bigger concern from investors is actually the rupee. I think that's a big challenge for India equities. When we speak to investors, and it seems to me it's become a bit of a chicken and egg situation, where the macro folks or the FX folks, they are looking for FI equity investors to come back, whereas the FII guys want rupee to stabilize. So you want to see some sort of a circuit breaker which kind of breaks this negative nexus.
I do want to ask this from a couple of lenses, right? So if I look at it from the perspective of the Indian investor purely, I'm wondering what you think about the earnings implications of a higher rupee and the lack of clarity on a trade deal, because I think both of these are tied. On the one hand, you don't have too much dependence on US exports, but there is a sentiment impact. So on earnings, there should not be too much of an impact of that. But what about the rupee, one? And two, from the perspective of somebody looking outside in, is that major trigger going to be the solution on the India-US trade deal and a sharp appreciation in the rupee, which some people are pegging at, what, another 3 rupees, 4 rupees sharp appreciation could take place. It could go back to 88 if things work out.
So I do agree that a US-India deal or some sort of an agreement could be a positive trigger. I also 100% agree with you that fundamentally the tensions or these higher tariffs India has been imposed will not have a meaningful impact on growth or even corporate earnings. But optically, narrative-wise, it is a negative because it is an overhang on the market. And the longer it takes for India to come up with some sort of an agreement with the US, I think the bigger the challenges will be. In fact, I think a couple of days ago, I think yesterday, there was a comment from the chief economic advisor suggesting that maybe the deal may not be imminent, but he is expecting the deal to happen sometime before March. So I think this is a slight negative, I would say, but I do agree. I think a deal would be positive for the optics, for the narrative. It will make people, foreign investors, more comfortable. I think right now there's just too much uncertainty. I think the risk or the concern investors is like, will services exports, say, for example, be also included as part of these tariffs, or they're being tariffed or taxed. So I think that'll be quite important. As far as rupee view is concerned, we as a house, Nomura is expecting rupee to continue to depreciate. For first quarter, we are looking at around 92, but for after end of Q1, we are expecting some bit of stabilization in the rupee through the year, because generally as a house, our view is softer dollar beyond Q1 of 2026.
It's interesting to hear, Chetan, because quite a few houses have the view that the worst is over for the rupee. And here we're penciling in, Nomura is penciling in up to a 92 for the dollar. Having said that, does that leave room for a positive surprise? Because the point that you're making and the commentary by the chief economic advisor sort of got negated by what the Commerce Minister then said, and the fact that there was a call overnight between Prime Minister Modi and President Trump. What does the chances of a positive upside look like for the rupee and for Indian equities, and by extension, FIIs coming in?
So the positive upside will be, let's say this deal is literally in the next few days. Second could be, and let's say for some reason, global investors give up on this AI thematic. As you know, this has supported not only the US markets, but also some larger markets in Asia, particularly Korea, Taiwan. And let's say we see a decisive turn in this thematic. I think then you can potentially see some reallocation flows coming into India equities. Now, that's not our call. We are thinking about India mostly as a diversifier in portfolios. But let's say if somehow we see this narrative around AI thematic turning, then you could see potentially foreigners coming back. Because as you know, there has been massive selling from foreign equity investors of India stocks. And if you look at the allocation of even Asia ex-Japan funds, I'm not talking about emerging market funds, talking about Asia ex-Japan funds, these funds are actually underweight India. They are neutral to slightly overweight China, but they are underweight India. So emerging market funds are underweight India. And also on top of that, even Asia ex-Japan funds are underweight. So you could see potentially some reallocation coming to India. And I think that could be the upside risk also for rupee.
Let me come to what you're liking from an India perspective. And your report, of course, talks about details of what you like in the whole region. But I'm going to sort of slice down to India. And among the other things, what I saw was Indian autos. What else are you liking, and why Indian autos? Because that GST cut boost, is there more to come in your view?
So, as far as India portfolio positioning is concerned, our India team also has put out a separate, fairly big outlook report. But actually, their stance is, just bottom up selection, be selective, choose stocks across sectors. But if you really have to force us to come up with a couple of sectors, I think financials looks quite interesting. But on top of that, there are sectors like, IT, pharma, where we've turned more constructive because the sectors have derated and underperformed. So I think those are two other sectors. As far as autos is concerned, yes, I do have one auto stock in the AEJ, the Asia ex-Japan model portfolio that we run, but it's purely a very idiosyncratic, company-specific reason why we have that stock. We also have a auto components player, but that we are choosing those stocks purely from a thematic perspective. You want to have some companies which are continuing to come up with new models. We also want to have companies which are kind of levered to this EV thematic. They're producing or manufacturing components which go into electric vehicles. So I think that's how we are looking for for stock picks. So it's not really that we are constructive on autos, and I understand auto stocks have done quite well, but it's really we're trying to pick bottom-up stock ideas.
Chetan, just to close out this conversation, my question to you is this. The base case seems to be that India is viewed currently from a global standpoint as a fringe or a diversification idea, right? My question to you is, what would need to happen for that to change materially in 2026, if at all?
Well, as I said, let's say if the AI trade rolls over, I think people will look at India. I mean, India remains one of the largest markets in the emerging market universe. We've quoted these statistics many times in the past. There are still more than 200 stocks in India which trade more than 10 million a day. That's a liquidity threshold most global investors look at. No other market, not Korea, not Taiwan, has that kind of depth to offer. You also have breadth. So I think if the global thematic around AI rolls over, I think people will look at India. I think that's going to be very interesting in my view. Maybe there is more impetus on reforms. Maybe that will make the India story more exciting. I think those are the things I would look at. But yeah, for me, for foreign investors to come back wholesale to India, the key is what happens with the AI tech trade. I think that's the key.
Chetan, absolute pleasure speaking with you. Thanks so much for taking the time. Wish you happy holidays.